Coming into this print today, this was the view from Barclays. They were looking for durability in the US labour market, but they were still looking for 75 basis points of cuts this year. They said the following: there's enough durability in labour markets, enough of a services-oriented economy where weakness in manufacturing and trade have difficulty tipping the economy over. One of the reasons we're not calling for anything worse is because we think there's still some virtuous cycle in labour markets left to go. That was the optimism before the print. Is it still there? Barclays chief US economist Michael Gapen joins us now. So Mike, help us answer the question. What's your view now? Has it changed?
Okay, that's not fair. Yeah, so obviously the number today, if you look at the 1 month number, casts some doubt on what I just said. I agree with Anastasia. The numbers are suggesting weakness in manufacturing, industrial production, the cyclical side of the economy. Having goods producing sectors and employment in those sectors go to zero is what happened in 15 and 16. So that side of the report isn't a surprise. The services payroll numbers today won't get it done. The 3-month average, as Rick said, is probably more in tune with this. So, yeah, obviously today's report is a little inconsistent with what I said. But, yeah, our view is that it is hard to tip the U.S. economy over if it's just a slowdown in manufacturing.
So this is a really important point. And, Mike, we're certainly not trying to play got you here on Bloomberg.
Sure,
I want you to go through the details more broadly for this U.S. economy. The ADP report earlier in the week just spoke to the anxiety. Goods-producing areas of the economy not doing so well. Services okay. We actually still see this in Europe too. You think that could remain the trend for the next 12 months or so? That's your base case?
It's the base case with sufficient monetary policy easing that comes in to stabilize confidence. I think the monetary policy setting is too tight given weakness in global growth, escalating trade tensions, and so forth. I'm not sure we need tariffs to go into place to get things to slow down. The April data, industrial production, durables orders, advanced trade, all that took our tracking estimate for equipment spending into negative territory for the month. That's what really got me worried, more than a tweet on trade. It was that April data on manufacturing and industrial production that suggested much more broad-based weakness in business spending, and that's what took our numbers down.